Let's be real. If you've got a big finance or consulting interview coming up, the accounting questions are probably what's keeping you up at night. They can feel like this huge, impossible wall, but they don't have to be. That's why we're here. We're going to break down the absolute core concepts you need to nail and turn what feels like a weakness into your biggest strength.
So here's our game plan. First, we'll tackle the interview itself. What kind of questions are they going to throw at you? Then we'll dive deep into the big three financial statements, pull them apart to see what makes them tick, and then, most importantly, see how they all connect. After that, we'll jump from theory to practice with operating models, and we'll finish up with a step-by-step blueprint to build your very first one.
All right, part one, the interview challenge. Let's talk about what to expect and how you can prepare, because knowing your enemy is half the battle, right? When you're sitting in that interview room, they're not just giving you a pop quiz to see if you memorize definitions. They're trying to figure out how your brain works. They use these accounting questions to see if you can see the bigger picture, to understand how all the gears of a business mesh together.
You can pretty much expect the questions to ramp up in difficulty. They'll start you off with the basics, the conceptual stuff like, hey, what's accounts receivable? Then they'll move on to single-step scenarios. A classic is, what happens if depreciation goes up by $10? After that, things get trickier with multi-step problems, where one change causes a whole domino effect. And if they really want to see what you're made of, they'll hit you with advanced topics like deferred taxes or M&A accounting.
Okay, at the absolute heart of everything we're talking about are the three financial statements. You can think of them like a complete health checkup for a company. Each one tells a totally different but equally critical part of the story.
First up, you've got the income statement. This is basically the scoreboard. Over a specific period, like a quarter or a year, did the company win or lose? It tallies up all the revenue, subtracts all the costs, and gives you that famous bottom line, the net income. Simple as that.
Next, we have the cash flow statement, and this one is so important. Why? Because profit isn't cash. This statement is the ultimate truth teller. It follows the actual money, tracking every single dollar that physically moved in or out of the company's bank accounts.
And rounding out our trio is the balance sheet. Now this one's different. It's not a movie showing what happened over time. It's a photograph, a snapshot, taken at one specific moment that lists out everything the company owns, its assets, and everything it owes, its liabilities and equity.
So let's just boil this down because it's crucial. The income statement shows you performance over a period of time. The cash flow statement shows you liquidity over a period of time. But the balance sheet, that shows you the company's position at a single point in time. Getting that period versus point distinction is absolutely fundamental. Okay, we've got the 30,000-foot view. Now it's time to zoom in. Let's peel back the layers on these statements and really understand the key line items that make them up.
But before we go any further, you need to tattoo this on your brain. It's the golden rule, the fundamental law of financial physics. Assets must equal liabilities plus equity. It's not a suggestion, it's a law. This equation is the entire foundation of the balance sheet, and it must always balance. Now, inside the balance sheet, things are basically sorted into two big buckets, current and long-term, and the magic number is 1 year. Current means you expect to turn it into cash or pay it off within a year. Think cash itself or inventory. Long-term is anything that sticks around for more than a year, like a factory or a big loan.
And here is a classic interview trap. You know that we depreciate assets like buildings and equipment over time as they get worn out. But there's one giant exception you have to remember. Land does not depreciate. They love asking this one, so don't fall for it.
Here's another one of those little details that really separates the people who know their stuff. It's about dividends on the cash flow statement. If your company receives a dividend from an investment, that's cash from operations, or CFO. But if your company pays a dividend out to its own shareholders, that's cash from financing, or CFF. It's a subtle point that shows you've gone deep.
All right, now for the main event. This is where it all comes together. See, these statements aren't three separate documents. They're all connected, woven together in this beautiful logical loop. And understanding this flow, well, that's the secret weapon for crushing those interview scenarios.
So let's trace the connections. It all kicks off with the bottom line of the income statement. That final number, net income. That's your profit for the period.
So what happens to that net income number? You literally pick it up and carry it over to become the very first line at the top of the cash flow statement. It's the starting point for figuring out your actual cash from operations. You start with profit, and then you make adjustments to get to the real cash.
Then you work your way all the way down the cash flow statement through operations, investing, and financing, and you calculate your ending cash balance. This is the amount of actual cash you have in the bank at the end of the period. And here's the final magical link. That ending cash balance from the bottom of the cash flow statement flows directly onto the balance sheet. It becomes the cash line item under your assets. This is what ensures that the whole thing balances. It's a perfect, self-correcting circle.
Okay, so we've gotten really good at reading a company's financial history. But let's be honest, in finance, you get paid to predict the future. And that is exactly where the operating model comes in. This is how we take all this theory and put it into practice.
So who actually uses these things? Pretty much everyone. The insiders, the corporate finance teams, they use them for internal planning and budgeting. And the outsiders, like investment bankers and research analysts, use them as the engine for all their valuation work. We're talking DCFs, LBOs, the whole shebang. Now, building a financial model can sound really complicated. I get it. But honestly, it's just a process. It's like following a recipe. So let's walk through the blueprint step by step so you have a clear roadmap.
Here we go. Step 1. You can't look forward until you've looked back, so you start by plugging in the company's historical financials. Step 2. You project the income statement, making assumptions about how fast revenues will grow and what your margins will look like. Steps 3 and 4 are kind of a dance you do together. You project the balance sheet items and then make the necessary adjustments on the cash flow statement. A big part of this is building out detailed subschedules, like for working capital. Step 5 is a big one. You build a detailed schedule for your property, plant, and equipment, or PP&E, to track all your big purchases and depreciation. And now for the masterstroke. Step 6. You build a debt schedule to forecast your interest payments. Then, and this is the key that makes the whole thing work, you link that interest expense figure back to the income statement. That's what makes the model a dynamic, living, breathing forecast.
And there you have it. We've gone from the basic interview questions to the 3 statements, to how they connect, and finally, to a real blueprint for forecasting the future. But look, theory is great. The only way this stuff really sticks is by doing it. You have to get your hands dirty. So now that you have the blueprint, the only real question left is, what company will you model first?